The Federal Reserve is on the brink of a decision that could impact every American household, every business, and every corner of the U.S. economy. Imagine this: your mortgage payments, your credit card bill, your car loan, even the cost of borrowing money to expand a small business, all of it could change within hours. Today, the Fed is expected to cut interest rates for the very first time this year. But what makes this move extraordinary is not just the cut itself, it's the timing, the pressure, and the risks involved. Will this decision bring relief to struggling families and businesses, or will it add fuel to an already uncertain economic fire? Stay with us, because over the next few minutes we'll break down why this moment matters more than ever. The announcement is set for 2 p.m. Eastern Time, and financial markets, investors, and ordinary Americans are bracing for impact. Rate cuts usually mean cheaper loans and more breathing room for consumers. Businesses can borrow more easily to expand, while credit card interest can come down, making debt a little less painful. But this isn't happening in a vacuum. The economy right now is sending mixed signals that are confusing even the experts. Job growth is slowing. Inflation is ticking up. And politics? Well, politics are louder than ever, with the Federal Reserve facing attacks on its independence from Washington. Just last month, America added only 22,000 jobs. To put that in perspective, economists had expected several times that number. Even worse, the country actually lost jobs back in June. For the first 8 months of 2025, the U.S. economy added just under 600,000 jobs. Compare that to the same period in 2024, when the economy added 1.4 million jobs. That's less than half the pace, and it's a slowdown that has policymakers worried. And here's something striking. Unemployment ticked up to 4.3%. That may not sound high, but it's the worst level outside of the pandemic since 2017. 31,921. That means more Americans are finding it harder to get work or holding on to the jobs they already have. Now here's where things get even more complicated. Normally, when the economy slows and unemployment rises, the Federal Reserve cuts rates to stimulate growth. Lower rates make it cheaper for businesses to hire and invest. But right now, inflation is also creeping up. Prices rose from 2.3% in April to 2.9% in August. The Fed's target is just 2%. So here's the dilemma. Cut rates to help workers, and you risk driving prices even higher. Hold rates steady to fight inflation, and you risk pushing the job market further into trouble. It's a balancing act like walking a tightrope in a storm. And this brings us to the core question: how will ordinary Americans feel the impact? Think about families juggling mortgage payments or credit card bills. For them, a rate cut could bring much-needed relief. Small business owners could take out loans at cheaper rates, maybe hiring back employees or expanding into new markets. But at the same time, if inflation continues to rise, the relief might be short-lived. Groceries, gas, and healthcare costs could keep climbing, erasing the benefits of lower borrowing costs. Now, let me ask you this: if you were in charge of the Fed, what would you prioritize? Jobs or inflation? That's the exact debate economists are having right now, and there's no easy answer. Some say the Fed should wait, let the data play out, and avoid repeating the mistakes of the past. Others argue that delaying could deepen the pain in the job market. And that tension, that uncertainty, is what makes today's decision so historic. According to economists at Morgan Stanley, the most likely outcome is a gradual, cautious approach. A quarter-point cut today, with the Fed signaling that future moves will depend on incoming data. In their words, policy is not on a preset course. Goldman Sachs analysts echoed the same view. They believe the weakening labor market, with job growth falling below the break-even rate, makes a rate cut not only likely but necessary. They also warned that unemployment has been rising for 2 months straight, and broader signs of labor market slack, meaning underemployment and people dropping out of the workforce, are flashing red. But let's zoom out for a moment. Behind the numbers, behind the forecasts, there's also the political dimension. President Donald Trump's sweeping reciprocal tariffs earlier this year have reshaped trade and pushed up costs. Inflation has climbed since those tariffs were announced, and businesses across the country are warning about slower consumer spending. The Fed is supposed to be independent, making decisions based on economic data, not politics. But in reality, it's impossible to separate the two completely. The pressure is real, and the stakes couldn't be higher. Now think about this. If the Fed cuts rates today, it might not be the last time this year. In fact, markets are already pricing in a high likelihood of 3 separate cuts before December, totaling 3/4 of a percentage point. That means the era of higher borrowing costs could be coming to an end, at least temporarily. But every move comes with consequences. Too much easing and inflation could spiral. Too little and the job market could slide deeper into weakness. Here's a question for you. How confident are you that the Fed can thread this needle? Because history tells us that central banks often struggle to strike the perfect balance. Cut too late, and you miss the chance to cushion the economy. Cut too early, and you unleash inflationary pressures that take years to tame. This is why investors, economists, and policymakers are watching so closely. The path chosen today could shape the direction of the U.S. economy not just for months, but for years. Let's not forget the human side of the story. Behind every statistic is a family making tough choices, whether to take on debt, whether to cut back on spending, whether to hold off on buying a home. Behind every percentage point of inflation is the cost of a gallon of milk or the bill at the grocery store. Behind every uptick in unemployment is someone searching for work, hoping for stability. This isn't just about charts and numbers. It's about real lives, real struggles, and real opportunities. So as we wait for that 2 p.m. announcement, the country stands at a crossroads. Will the Fed's move stabilize the economy or deepen the uncertainty? Will Americans feel relief in their wallets or frustration as prices keep climbing? We'll know soon enough. But one thing is clear, the decision today is not just about interest rates. It's about confidence, about leadership, and about the ability to navigate a fragile economy in turbulent times. Now let me leave you with this thought. When history looks back at this moment, it won't just remember the numbers. It will remember whether policymakers rose to the occasion, whether they made the tough calls, and whether they put the American people first. That's the weight of today's decision. And we'll be here to track every development, every ripple, and every consequence that follows. Because when the Federal Reserve acts, it doesn't just change Wall Street. It changes Main Street, your street, and every street in America.